So friend, we now move on to the last technical session for the day, which focuses on the opportunities and challenges in respect of the accounting reforms in the Indian Railways. And before I invite the panelists for the technical session 3, let me start with playing a video on the experience of how Russia has done it, what has been their experience on transition to the accrual accounting. The video is by Maxim Savostianov, who has worked extensively with the Russian Railways and the Ministry of Finance in Russia on the large accounting projects. The video, besides discussing about the accrual accounting, also discusses about concepts such as the service potential of an asset which are highly relevant for a government entity, since these are largely not-for-profit entities and also need to meet the social agenda of the government. The Indian Railways will also be able to link up the experience of the Russian Railways with what now the Indian Railways will be doing. And this is about a 5-6 minute video, and then I'll be inviting the moderator of the session, CA Nilesh Vikamse, and the other panelists on the dais.
Hi, my name is Maxim Savostianov. I am an EY assurance partner based in Moscow. Russian Railways consist of 16 main business units called railroads: Moscow Railroad, Far East Railroad, etc. Each of them produces their own financial statements, subsequently consolidated, and the management can compare the performance of the individual business units, such as profitability or level of working capital, etc. The profit of each business unit is calculated using the same accounting principles and classification of expenditure, such as direct and indirect costs, depreciation of fixed assets, etc. Obviously, such comparison would be distorted under cash accounting basis if we compare just the cash inflows and cash outflows. Under this scenario, an entity needs to plan and control revenue and expenses in parallel with the cash inflows and outflows. This is why all our clients, including both commercial sector, state-owned companies, and the government entities, have two types of budgeting: the budgeting for the revenues and expenses under accrual principle, and cash flow budgeting, the forecast of their cash inflows and outflows. This creates additional cycle of control and performance management. In addition to that, the accrual-based accounting brings in the concept of equity and the ability to measure how the equity develops, whether it increases or decreases. And such monitoring of equity development is one of the key metrics in assessing how well the management of the organization does its work. Getting back to our example of the Russian railroads, it is also important for the government and the society as a whole to understand the real cost of the transportation. In Russia, Russian Railways is the biggest employer countrywide and one of the major contributors to the GDP. At the same time, it is a key element of the social infrastructure, and therefore the pricing and tariffs are regulated by the government. And it is very important to find the right balance between the profitability of this organization, so that it continues to operate and pay salaries to their employees, and the pricing that is socially affordable. In order to find the balance, we need to understand the real costs of the transportation incurred by the railways. What is the level of their real profitability, and whether in order to achieve the socially acceptable levels of tariffs, we need to subsidize the company or not. And if yes, what is the fair amount of that subsidy? In order to make all these assessments, we need to have a proper accrual-based accounting. The accounting that can match the expenses and revenues in the correct period that they belong to, and eliminate the distortions caused by the cash accounting, as we discussed above. Going further, transition of the companies from general accrual accounting to IFRS or IFRS can bring in additional advantages in analyzing and interpreting the information, as some new concepts are introduced. If you look at the financial statements of the Russian railways, the fixed assets represent over 80% of their balance sheet. The way we account for the fixed assets may have a major impact on the financial statements, including the profit and loss statement. This will impact upon all the matters that we discussed above, including the performance management and discussions around the tariffs. The depreciation rates and the impairment of the assets are obvious examples. It is important that IFRS, as well as IPSAS, allow us to select the depreciation rates in such a way that it reflects the actual duration of use of an asset and timely allocate the cost of the asset to the cost of the goods or services produced and sold. Another IFRS concept that appeared quite relevant for the Russian railways is the component accounting. When the useful lives of parts of an asset are different from each other, we account for them separately and depreciate them separately as well. And when we have to replace a part of an asset, for example, a section of a railroad track, say, as a result of some sort of natural disaster, we can take out of balance sheet one asset and create another asset instead. While under cash accounting, we would have a huge cash expense. Under IFRS, we have a new asset created. The asset will be subsequently depreciated and the cost will flow into the profit and loss statement gradually as the new asset is being used. This clearly has a positive impact upon the operational profit of the organization. Another interesting concept that we are currently introducing under IPSAS as part of our project for the Ministry of Finance in Russia is service potential. Although not currently applied by the Russian railways, it is interesting to consider, especially comparing it to the effects of impairment on the long-term assets under IFRS. Under IFRS, the primary value of an asset is its ability to generate future cash inflows. This is a reasonable concept from a point of view of a commercial entity. In the public sector, the assets occasionally do not generate any cash flows. In order to address this, a concept of service potential is introduced. According to IPSAS, service potential is the capacity to provide services that contribute to achieving the entity's objectives. Service potential enables an entity to achieve its objectives without necessarily generating any cash inflows. In the public sector, the primary reason for holding property, plant and equipment and other assets is for their service potential rather than for their ability to generate cash flows. If we look at the assets of an infrastructure company, for example, an electrical distribution grid or a railroad, due to tariff regulation, ability of its assets to generate future cash flows may be somewhat limited. One needs a lot of money to build the infrastructure, but one cannot set the service fee high enough to fully recover the costs incurred, as the government limits the tariff. Under IFRS, this would result in impairment of such an asset. At the same time, if we apply IPSAS concept of service potential, we say these assets are held by the public sector to provide service to the citizens, therefore should not be impaired, and we can continue to recognize them at their current value. So many interesting concepts to consider and a long road ahead to implement them.
Now I have the pleasure of introducing our panel for this technical session 3. The moderator of the panel is none other than C. Nilesh Vikamse, who is the Vice President of ICAI and will soon be the President of ICAI in about 2 months from now. He is a very esteemed friend and he's been the first chairman of QARC of the Security Exchange Board of India, is a member of SCODA, is the director of ICAI ARF, and joining him is Mr. Satyendra Kaushik, who is the Chief Project Manager, Accounting Reforms, Indian Railways, who's been a civil servant with the Indian Railway Account Service and has also been a director with the IRCTC and IRFC. Then we have Mr. B.V. Goyal, who is the advisor to the Institute of Cost Accountant of India. He has over 3 decades of experience working with the Government of India in various ministries and departments. And we also have Mr. A. Venkateshwar, who is the consultant, Accounting Reforms, Railway Board and the Rail Regulatory Bill. He is a 79 batch IRAS and has been on the board of 2 PSUs and has been the Director of Finance in the power and the energy sector. So I would request the moderator as well as the panelists to join on this stage.